Hello friends, I am Dipesh Majhitia from JK classes. We are here to discuss November 24 FR RTP. November 24 FR RTP. The RTP is really simple. Most of the questions are repeated. Few questions here and there. We'll crisply discuss the questions which are new, I felt. Rest which are theoretical or which has come in earlier RTP or past examination which you would have already done, that I am not doing discussion. Correct? So let's move ahead without wasting your time. I know you would be very busy preparing exams. This is your MCQ section starting case scenario 1. Now in case scenario 1, D Limited prepares a financial statement on 31st of March each year following. The information on revenue transaction are relevant to the year ended 31st of March 2007. On 1st October 2006, D Limited sold a product on 1st October 2006. D Limited sold a product to a customer for 1,21,000. I don't know why I look at this 1,21,000, I always feel 1 lakh plus 10% plus 10%. Anyway, this amount is payable on 31st of December 2028. So after 2 years, obviously there is a financing cost, which as we saw and you would have also interpreted, because this figure you must have also come across. The manufacturing cost of the product D Limited was 80,000. The customer had right to return the product for a full refund at any time, including 31st December. When there is a right to return the product and there is a full refund policy, then as per 115 chartered, you are supposed to recognize revenue only after subtracting expected return. Suppose 100 rupees you have sold the goods and you are expecting that 20% would be returned based on your past experience, then you can recognize revenue only up to 80 rupees, correct? So you are supposed to estimate that how much return would come and the balance revenue should be recognized, correct? At 1st October, D Limited had no reliable evidence regarding the likelihood of the return of the product. 1st October ko they did not have any reliable evidence regarding the likelihood of return of the product. Since they did not have any reliable likelihood of the return of the product, that means in that case on 1st October they cannot recognize any revenue. So they can recognize revenue only if the return period is over. And as we read the question, return period gets over on 31st of December. Therefore, they cannot recognize any revenue up to 31st of December 2006. And how much revenue they can recognize? Present value of 1,21,000 or cash price, whichever is given. Fair enough. Now, the product was not returned by the customer before 31st December 2006. Thank God, bach gaya. Product was not returned. Since the product was not returned, the entity can recognize entire revenue on both 1st October and 31st December. So the right to return customer expired on both 1st October 2006 and 31st December 2006. The cash selling price of the product was 1 lakh. Cash selling price of the product was chartered 1 lakh. That means if you buy it today, you are supposed to pay 1 lakh. If you buy it if you are making the payment after 2 years, you are supposed to pay 1,21,000. So by default, you can assume that the discounting is at 10%. So chartered first, when they can recognize revenue? They can recognize revenue on 31st of December. How much revenue they can recognize? They can recognize a revenue of 1 lakh on 31st of December. On the year ending 31st December, on the year ending 31st December chartered, 31st of March, year ending 31st of March, there would be interest element added to trade receivables. So on 31st of December chartered, they would recognize a revenue. So on 31st December, they will pass the entry trade receivables to sales 1 lakh. 31st March को they will pass the entry trade receivables to interest, that is 1 lakh into 10% for 3 months, that is 2500. Correct? Now chartered, first paragraph is over, so let's see what are the questions based on first paragraph. When and by what amount the revenue be recognized with respect to sales on 1st October? When? 31st December, and how much? 1 lakh revenue. 31st December they can recognize the revenue of 1 lakh. Correct? What will be the amount of finance income to be recognized with respect to sales in the year 0607? So year end May they will recognize a finance income of 2500. What will be the amount of trade receivables? 1 lakh plus 2500, that is 1 lakh 2500 will be the trade receivables. Correct? ये तो मस्त है. So they'll recognize the revenue on 31st of December. They will recognize the revenue of 1 lakh. Trade receivables will be 1 lakh on 31st December. 3 months का interest add करेगा 2500, and 31st March को debtors will become, your trade receivables will become 1 lakh 2500. What will be the amount? Now this is next. So 1, 2, 3 हो गया. Now on 1st July, D Limited began an arrangement to sell the goods to a third party, B Limited. Third party they have told, that means it is not a related party. The price of the goods was set at 100 per unit for all the sales in the 2-year period. ठीक है? 2-year period में we are supposed to make sales and the selling price is 100 rupees for a 2-year period ending on 30th of June. However, if the sales of the product exceed 60,000 in the 2-year period ending 30th June 2007, so they entered into contract on 1st of July. They entered into contract on 1st of July, and the 2-year 5667 is the 2-year contract. Selling price is 90 rupees. But if the sales exceed 60,000 units in total 2-year period, that means in total 2-year period, if the entity gets an order of more than 60,000, exceed 60,000, not equal to 60,000, exceed 60,000 units in 2-year period ending 30th June, then the selling price of all units will be 90 per item. Fair enough. Now, sales of the goods in the 9 month ending 31st of March 2006. In 9 months, from where did it come, sir? Sir, this 9 months came from 1st July 05 to 31st March 06. First 9 months are over. Total 20,000 units, and this volume of sales per month was not expected to change before 30th June 07. Okay. That means they are assuming that 60,000 will only be there. So it will not cross 60,000. Therefore, for 0607, they can recognize a revenue of only 20,000 into 100, that is 20 lakhs. Because 20,000 units of sales per month was not expected to change. So every year ka 20,000. 9 months. Correct. So 9 months में 20,000 है, तो 2 years में it will not cross 60,000. It will not cross 60,000. That means current year में they will record sales of, एक मिनट for your convenience और एक बात करते हैं, 20,000 divided by 9 into 24. 9 months में they have sold how many units? 20,000. Therefore, 24 months में how many units they are expected to sell? 20,000 into 9 divided by 20,000 divided by 9 into 24. Somewhere 53,333, which is less than 60,000 units they are expecting to sell over a period of 2 years, because they are saying that 20,000 they have sold in 9 months. and the rate of sale per month is not expected to change. So if they sell in this rate only over a 2-year period, that is 24 months, they are expected to sell 53,333, that is less than 60,000. Therefore, they can recognize the sales at 100 rupees only. The sales can be recognized at 90 rupees provided they are expecting that the sales would cross 60,000. Correct? Now, however, in the year ended 31st March 07, 20 they have sold, chartered 20 they have sold plus 35, 31st March tak. So 55 is sold. Total sales of the goods be 35,000 and based on the current orders from B Limited, the estimate was revised and the directors of D Limited estimate that total sales of goods to B Limited in 2-year period ending 30th June would be more than 60,000. Oh my God, more than 60,000 if it records, then they are supposed to recognize how much sales in the next year. Now chartered in the next year, they are supposed to recognize sales at 90. So 35,000 into 90, or rather I would say 55,000 into 90 is equal to 49,50,000 is the total sales which they should have done over a period of 2 years. Correct? No? इधर देखो, in July 05 to 31st March 06, we have recognized 20,000 into 100. Correct? That is how much? 20 lakhs we have recognized. And 1st April 06 to 31st March 07, they have sold 35,000 into 90. 35,000 into 90 is equal to 31,50,000. But from this 31,50,000 chartered, they have already recognized 20,000 into 100 over here. They should have recognized that also at 90. So 20,000 into 10, 2 lakh rupees extra sales recognized. So 2 lakh rupees will subtract. So they can recognize a sale of 29,50,000. Or we can say in 2-year period, that means 5-6 and 6-7 put together, they have sold 55,000 into 90. That is how much? 55,000 into 90 is equal to 49,50,000 is a sale to be recognized over a 2-year period, out of which 20 lakh sale has been recognized earlier. इसको catch-up agreement we say, no? You remember catch-up agreement 115 modification? 49,50,000 minus 20 lakhs is equal to 29,50,000 they can recognize. So 49,50,000 they can recognize over a 2-year period, out of which 20 lakhs they have recognized last year. So current year they can recognize 29,50,000. Or current year ka 31,50,000 plus 10 rupees excess sell on 20,000 units. 10 rupees excess sell on 20,000 units they had recognized last year, which should be removed. So it comes to 29,50,000. So in both the scenarios it would be same chartered. 29,50,000. Correct? 1, 2, 4. What will be the amount of sale to be recognized? 5-6 में 20 lakhs. What will be the amount of revenue recognized? 29,50,000. Done. Now, case scenario 2. Are you understanding? Yes, sir. Everything we understood. Move ahead. I know you're a champion, ready for your exams. bright future of this country. Messrs. XYZ and Company is an auditing firm. During his audit, the firm is facing difficulty in accounting of the following transaction for which it seeks your answer. A Limited seeks your answer and you are always ready. Now, A Limited has established a defined benefit plan. Defined benefit pension plan. Chartered, what do we call this? Sir, we call this as a PVDBO. What do we call this? PVDBO. For its eligible employees, the balance sheet as at 31st of March 07 currently includes estimated net liability. Net liability. Net liability means PVDBO minus plan assets is your net liability. PVDBO minus plan assets net liability is 18.75. So if your plan assets will increase, your net liability will decrease. If your plan assets will decrease, your net liability will increase. Correct? Yes, no? Yes, sir. Shall we move ahead? Yes, sir. Now, chartered. 18.75. The following matters relate to the plan for the year ended 31st of March 07. Current service cost was advised by the actuary 6 crores. So journal entry would be CSC to PVDBO 6 and PRL to CSC 6. On 31st of March, A Limited paid contribution of 7 crores into the plan and charged this amount to operating expenses. Paid contributions of rupees 7 crores into the plan and charged this amount to that means they invested in the plan assets. So they should have passed the entry. Correct entry should have been plan assets to cash bank. Wrong entry is PL to cash bank. Therefore, rectified entry is equal to plan assets to PL 7. If plan assets is increasing, therefore your net liability will reduce and your PL will go up by 7. The actual market yield on high quality corporate bonds on 1st April was 8%. So interest will come to 8% of 18.75. 18.75 into 8% is equal to 1.5 crores. Entry is interest to PVDBO. Interest to PVDBO and PL to interest. How much? 1.5. So PL is decreasing by 6, increasing by 7, decreasing by 1.5. The estimated net liability, okay, is now charted. So net liability was how much? 18.75 का net liability, correct? Plus interest, how much? 1.5 plus CSC, how much? 6. So 18.75 plus 1.5 plus 6 minus contribution 7 minus contribution 7. Why did I subtract contribution? Contribution will increase plan assets. That means your net liability, if assets will increase, net liability will decrease. Are you understanding? Suppose 100 rupees is as liability, 20 rupees asset, so net asset is 80. But if this becomes 25, then this will become 75. So if asset goes up, liability comes down. Correct? This was an assumed number. Otherwise, you will start thinking, from where did I get this? So if net assets have gone up by 7, your net liability has gone up, if your plan assets has gone up by 7, your net liability has come down by 7. So minus 7. So present value will become how much? 19.25. But they are saying how much? 20.5. Oh my god, so liability has gone up. Minus 20.5, liability has gone up. 1.25 का actual loss. Correct? Impact on PL. Impact on PL is how much? PL is increasing by 7. Credit 7. Decreasing by 6 and decreasing by 1.5. So 0.5 ka net impact in PL debit expense. So we have done. So opening net liability was 18.75. That will increase by interest. That will increase by CSC. That will decrease by contribution to plan assets. Correct? So net value of net balance of liability comes to 19.25, but they are saying 20.5. Therefore, that is an actual loss which will go to OCI. Correct? And P&L mein this 3 items ka impact. 7.5 will go as expense, 7 will go as income. So net expense will be 0.5. Correct? Now, chaliye. Question case scenario 2. What is the net adjustment to be made in statement of P&L? Deducted expense. Correct? What is the amount of actual gain or loss? Actual gain or loss is 1.25. Correct? Actual gain or loss is 1.25. Correct? Now, thereafter, what is the original provision required? Restoration. This is 8. No, this is different. So these two ka answer we got. Correct, incorrect? Correct. Now, shall we move ahead? You could not find out net impact without doing 7, 6 and 1.5. So all the calculations which we did were necessary. Part 2. E Limited completed construction of a non-current asset. This was there in November 23 RTP in a full-fledged consolidation ka question. A part of that has been picked up again and put. We'll read it any which ways. On 1st April 2010, E Limited completed a construction of a non-current asset with an estimated life of 20 years. Okay. The cost of construction were recognized in property, plant and equipment and depreciated appropriately. That means equally SLM. E Limited has a legal obligation. Legal obligation as per section Ind AS 37. Legal obligation. Isko we call it DSR, decommissioning and site restoration, dismantling, decommissioning, site restoration expenses. We used to bring it to the present value. Whatever we are going to incur in future for decommissioning, dismantling and site restoration expenses, which we are going to incur after 20 years, we are supposed to find out the present value of that and add it to the cost of the asset. Correct? And we are supposed to pass the entry PPE to provision. Let's see what they have done. To restore the site on which the non-current asset is located on 31st of March 20, the estimated cost The estimated cost at 31st of March 20 is 2.5 crores. That is, after 20 years, the cost will be 2.5 crores. That means after 20 years, we are supposed to incur 2.5 crores. The directors have made a provision of 0.125. 1 by 20 divided 2.5. 2.5 we are going to incur. They did not find out the present value. They simply divided by 20 years and created a provision of 125. Have made a provision of 0.125 in the draft balance sheet and appropriate annual accounts. The estimated cost of this restoration work on 31st of March 20, that is after 20 years, is 2.5 crores. The directors have made a provision of 0.125 crore in the draft balance sheet as at 31st of March 2001. An appropriate discount rate to use in relevant calculation is 6%, and this rate at present value payable in 20 years is 0.312. On the basis of the facts, answer to the question relevant in the 16. So they have made a provision of how much? Have made a provision. Directors have made a provision. Oh my God. So they would have made a provision of PL2 provision. So rectified entry for that will be PL. So they would have passed the entry PL2 provision because they have made a provision of 0.125. So they have not adjusted with the asset. They would have created through PNL. So rectified entry will be provision to PL. How much? 0.125. B. Correct provision का entry PPE to provision. How much? 2.5 into 0.312. 2.5 into 0.312. 0.78. Then this provision would unwind and asset would depreciate. So interest to provision. Interest would be debited to PL. How much? 0.78 into 6%. That comes to 0.468. 0.468. And chartered debtion, that is again PL to PPE. How much? 0.78 divided by 20 years. 0.78 divided by 20 years. 0.39. So PL is credited. PL is credited. PL is debited. PL is debited. Therefore, net impact will be 0.125 credit, debit में 0.0468 and 0.78 divided by 20. 39. So net impact on PL is 0.125 minus 468 minus 0.39. So that is minus 0.468 minus 0.39. 0.390. 0.0392 positive. That means it will come in P&L credit. Now, what is the net adjustment to be made in statement of profit and loss account? For this we have done 6, 7. What is the original provision required? Original provision required is 0.78. Correct? Yes, sir. Next. What will be the amount of adjustment to be made in retained earnings, that is PL account, on account of restoration of provision? 0.391, 0. This one. 0.0392. Here. 0392 red wala may we have written. Can you see? Now, correct. So 0.125 PL credit, 0.0468 PL debit, 0.3900 over year charted PL debit. So net impact. Now, so we have done. What is the amount of 1 year's unwinding interest? Interest was this much. Correct charted? Yes, no. So case scenario MCQ done. Now, question number 11. X Limited is an Indian company, income taxes, deferred tax, easy standard. Now, an Indian company owns a freehold land with a carrying value of 10 lakhs, not depreciated, which is not depreciated for tax purpose, but it is indexed for inflation. Indexed value and fair value of such land is 15 lakhs and fair value is 22 lakhs. So, if he is following a cost model, then carrying amount is 10 lakhs. If he is following a revaluation model, then the carrying amount is 22 lakhs. Tax base is 15 lakhs. But tax base of indexation cost chartered is generally applicable if the asset is sold individually. If there is a slum sale, that means if he sold it in a group, then this tax base ka advantage the company does not get. Correct? Respectively, on the reporting date, what will be the tax base for such land for the measurement of a deferred tax? X Limited intends to sell it as a part of slum sale. As per the applicable tax laws in the jurisdiction, indexation benefit is not available if the freehold land is sold as a part of slum sale. So this is a provision that we would have known earlier only. But indexation benefit is available if the freehold land is sold individually. If X intends to sell it as a part of slum sale, carrying amount, what will be the tax base for such freehold land? Carrying amount, I don't know. X Limited intends to sell it as a part of slum sale. So tax base is 0 after using it for business purpose. Which model? Cost or revaluation? We don't know. So let's check. X intends to sell the land individually. So carrying amount, I don't know. Tax base will be indexation cost, that is 15 lakhs. X has classified such land as investment property. Investment property mein revaluation is not available, so carrying value 10 lakhs and not a slum sale. To sell it individually and not a slum sale. So tax base 15 lakhs. X follows a revaluation model. Chartered, it is told in fourth case that it follows revaluation model. So in case 1, 2, 3, we can very well assume that they have followed cost model. So in all the cases, if they have followed cost model, it would be 10 lakhs. However, you can take a different assumption, but I feel since they have told it's a revaluation model, implicitly in last situation, that means in the previous situation, they would have assumed cost model. Revaluation model for freehold land, therefore carrying amount will become 22 lakhs and intent to sell it individually, therefore tax base is equal to 15 lakhs. Now in case of asset chartered, if carrying amount is more than tax base, we create taxable temporary difference. So over here you will create taxable temporary difference, but over here carrying amount is lesser than tax base, then we create deductible temporary difference. Over here also carrying amount is lower than tax base, so we create deductible temporary difference. Over here carrying amount is more than tax base, so we create taxable temporary difference. Correct? Now let's move ahead. The 16 is a plain simple theoretical question based on whether to classify it as lease or not. This question is there in earlier in days 41 agriculture. Very simple question, events occurring. This was there in recent, I think 3 or 4 attempts back only this question had come in the examination. We have covered it in the classroom also. So we had covered this in an impairment ka chapter, where this is impairment of inventory and the property together, and it is based on event occurring after the date of balance sheet. So when we did it in the class, this same question we did it in impairment wala chapter chartered. In days 30, question number 15, that is impairment of asset. At 31st of March 2001, the assets of CGU are being reviewed for impairment. Acha. The carrying value of net CGU is 65 lakhs. Excluding any restructuring provision. Restructuring provision can be created as per Ind AS only if the plan is ready and it is approved. That means they have complete intention of doing restructuring. Then only they can create a provision for restructuring, else not. And the remaining useful life of the asset is 8 years. Fair enough. Okay. Management approved the budgets at 31st of March include a restructuring cost of 3,50,000 to be incurred in 2002. The restructuring is expected to generate a cost savings of 1 lakh per annum from 2003 onwards. Formal budgets have been prepared for 3 years to 31st of March 04. They are planning restructuring, that means they are not planning to sell. A zero growth rate is assumed because the market conditions are extremely competitive and this is expected to continue for foreseeable future. The future cash flows are with restructuring consideration, without restructuring. With restructuring consideration, you are expecting a cash flow this much, 10 lakh, 10 lakh 50, 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 10 lakh 50. But without restructuring, we are expecting 1 lakh less cash flows. Correct? Why? Because it is very clearly given over here, expected to generate cost saving of 1 lakh. So over here there is a cost saving of 1 lakh. So with restructuring you are able to generate more cash flows. Without restructuring you are able to generate less cash flows. And the first year there is a difference of 3.5 lakhs. Why? Because they have created a provision. If they are going with restructuring, there is a provision for which they would have spent 3,50,000. So if they are going under restructuring, this would be the expenditure. Correct, incorrect? This would be the expenditure. Now chartered. Shall we move ahead? Yes. So you understood. The asset value is 65 lakhs. They are planning a restructuring for which they require a cost of 3,50,000. They will create a provision. If they go ahead with the restructuring, then these are the estimated cash flows they are expecting. And if they do not go with restructuring, these are the estimated cash flows they are expecting. With restructuring, cash flows will be 1 lakh more. Why? Because they are expecting a cost saving of 1 lakh. Correct? So 65 lakhs का asset, restructuring cost 3.5 lakhs. तो first year में cash flows are 3.5 lakhs less compared to without restructuring. Correct? But thereafter every year cash flows are 1 lakh more. Correct? Yes, no. Yes, sir. Now, so chartered, there are two possible scenarios. One is with restructuring, without restructuring. The net cash flows without restructuring cost is 8,70,000 exceed the net cash flows with restructuring 5,20,000 by the amount of restructuring cost 3,50,000. Fair enough. The future cash flows which exclude inflation have been discounted at the rate of 4%. ठीक है. For simplicity, it has been assumed that cash flows arise at the end of each year. Compute the impairment loss. Now charted, this is very simple. Understand. Now, there is a CGU of 65 lakhs. 1 minute. There is a CGU of 65 lakhs and there are two possibilities. Correct? One is provision of 3.5 lakhs and it is without, this is with restructuring, and otherwise the provision is nil. Am I clear? Now charted, if there is a provision, net asset value, net CGU value is 61,50,000 and net CGU value is 65 lakhs. Then we are supposed to find out the recoverable amount, that is value in use, that is present value of future cash flows. There is no fair value less cost to dispose. Am I clear? So if they are planning a restructuring, there is a provision. If they are not planning a restructuring, there is no provision. Am I clear? Because provision can be created on restructuring only if they have planned reconstruction. It has been announced that they are going for restructuring. So they would have created a provision. Therefore, net CGA asset minus the provision liability would be 61,60,000. Now let's find, and if they are not planning about the restructuring, the CGU asset value is 65 lakhs because provision they would not have created. On these grounds chartered, compute the impairment loss 31st of March 2011 when restructuring cost is recognized in the financial statements at 31st of March 01. Restructuring cost is not recognized in the financial statement at 31st of March 01. So one is recognized, one is not recognized. Now, दोनों का present value charted, let's calculate. It's already given in the question solution. Present value of the cash flows. Yeah, 65,14,000 and 62,73,000. 65,14 and 60 14 and 62 73. Over here impairment loss is not there because recoverable amount is higher, and over here impairment loss will be difference of 2, that is 65 lakhs minus 6273, that is minus 6273, 2,27,000. Correct charted. So there were 2 points to be kept in mind. First, that whenever you are calculating CGU, you are supposed to subtract liability. Net CGU ka impairment you are supposed to compare. Second, provision can be created only if you are planning a reconstruction. Correct? And you are supposed to take the present value of future cash flows. That was simple. Correct? Now let's move ahead. After this, This was question number 38 is intangible assets, which is very simple. There is nothing rocket science in this. Property, plant and equipment. This is an institute material question. It has already been done in the class. Borrowing cost also we have done it in the class. Same question with same numbers. Consolidated balance sheet. We have done two such questions in the class. One is from diploma in IFRS and one is the same question because it has come into the exam, which involves little rectification of errors. And last one is nothing but a theory on joint venture. Let's read it. P Limited and Q Limited enter into a contractual agreement to buy a building that is 12 floors which will lease to other parties. Enter into a contractual agreement. Contractual agreement to buy a building that has 12 floors which they will lease to other parties. P Limited and Q Limited are authorized to lease 5 floors each. 5 floor each. तो P Limited के लिए 5 floor is a investment property. Q Limited के लिए 5 floor is an investment property. Only 2 floors are into joint venture. P Limited and Q Limited can unilaterally take all decisions related to their respective floors. Unilaterally means individually and entitled to all income from those. So for 5 floors, P is responsible for remaining 5 floors Q. So that is investment property. Ind AS 40. The remaining 2 floors will be jointly managed. All decisions concerning these floors must be unanimously agreed between the parties P Limited and Q Limited, who will share net profits or net assets in respect of these 2 floors equally. So they will share net profits in the ratio equally and net profit or losses equally. Correct? They both have rights to net assets. They both have rights to net assets. That means both of them, they don't have individual right on a particular asset and a particular liability. Correct? So they are contractually bound. They have got equal right on all assets and all liabilities, and they share profit and losses equally. 3 important points. First, it is contractual agreement. Second, they don't have right on individual assets or liabilities. Third, they have got right equally on all the net assets and share profit and losses equally. That means they bear all income and expenses. So what do you think, Chartered? It's a joint venture or joint operation? Joint operation. Contractual agreement. All assets, liability, all income, expenses. Therefore, net profit they share equally. If it was some assets, some liabilities, if there was no contractual agreement, if they had right on one asset and not on another asset, and one liability and not on another liability, expenses are shared in different ratio, income are shared in different ratio, then it can be joint operation. Otherwise, this is a clear-cut case of joint venture, whether the arrangement is joint operation or not. So correct, Chartered? It's a joint operation or joint venture? Joint venture. Am I clear? The crux is contractual agreement. They have share in net asset. That means all assets and all liabilities and profits. Am I clear? That's all for your November 24 RTP, Chartered. I am sure you would have understood everything. It's a plain and simple question. If this sort of question comes in your examination, I'm sure you would do wonderfully well. Anyways, God bless you. All the very best for your exams, and hope your preparations go in full swing and in the desired fashion you want it to. Thank you so much on behalf of JK Classes.